Hello everyone, today's video is part of a series of videos on investments, specifically how to value a company that you are thinking of investing in. So today we're going to look at one particular theory of how to value a company, and this is known as the Gordon Growth Model. So this is all about valuing an income stock, so a mature business that pays dividends year on year. How do you know the price that is quoted on this listed company is a good price or a bad price, if it's undervalued or overvalued? So one quick way you can do your own calculation to determine that is via what's known as the Gordon Growth Model. So underpinning this Gordon Growth Model, named after Professor Gordon, by the way, who was an economics professor several decades ago, he said that the value of any company is the sum total of all the future dividend payments that it will make, discounted back at today's price. So that's the fundamental starting point. So you add up all of the future dividends that this company is ever going to pay, and that broadly is the value of the business. But you have to make a few assumptions. The first assumption is, what is the next year's dividend going to be? So that's the first thing. Then the second assumption is the rate of growth of that dividend. How much will that dividend grow by each year, if at all? And then the third key assumption of the Gordon Growth Model is to say, well, what is your personal rate of return as an investor? Because you have a choice. You can put your money in somewhere else. You could put it in property or in gold or whatever kind of asset class. You have a choice as an investor as to where you put your money. So what is your own internal hurdle rate, as they say, your expected rate of return? What do you want as an investor? And those three things are the three components that we put into the Gordon Growth Model. So specifically, in terms of working out the mechanics of this, we start off with next year's dividend. So let's say next year's dividend is expected to be 10 pence per share. So we start off with an equation that is on the top, 10p per share. And then we divide that by the expected rate of return less the expected growth rate. So let's just delve a bit deeper into those two things. So what is the expected growth rate of the dividend? Well, you could assume that it's fair to assume that it's the GDP growth rate of the whole of UK PLC. Now, setting aside the current pandemic and the COVID and everything else, in normal times, let's assume it's 2.5%. Then on top of that, you need to add an element for inflation. Say 2%, the Bank of England's target inflation rate. So expected growth rate of the dividend, 4.5%. Okay? 4.5% each year is what you would expect as an investor that dividend to grow by if you invested in that share. Then we come on to the third element of the model, which is the expected rate of return. So what is your expected rate of return as an investor on investing in that stock? Well, the first place to really look to get a benchmark is, what is the rate of return on a bond issued by that company? As a bondholder, you expect to receive less than a shareholder. So if you have a look at the published figures for that PLC that you're looking at investing in, see what corporate debt yields have been, that's a good place to start. So let's say that is 4%. Okay, so that's 4%, and then on top of that you factor in a bit of inflation. So let's say we get to with the 2% on that, so let's say that gets us to 6%. But then on top of that, you have to factor in what you call your premium for wanting to invest in the shares over and above the fact that it's not debt. So there is a expected return as a shareholder that you can expect to receive over and above being a bondholder, as bonds are more safe. So let's say that premium is 3%. So then we add on the initial base of the bond, 3, plus inflation of 2, plus your risk premium for investing in the share of 3, and that gets you to 9%. So that is your own expected rate of return on that investment of the share in that particular PLC. So then we factor all those into the model. So we've got, remember, the starting point is 10p, and then we divide that by 9% expected rate of return less 4.5% inflation, or rather expected growth of the share, which includes inflation. 9 minus 4.5 leaves us with 4.5 as the denominator of this model. So it's 10p divided by 4.5%. That works out at about 225p per share as a value of that business based on those assumptions in the Gordon growth model. Now, all you do then is compare it to the current share price. It's a listed company, share price changes daily. So if you've just worked out that it's intrinsically worth 220p and the share is actually trading at, say, 170p or 180p, then straight away you've got a bargain and you'd look to invest, because you've just worked out it's actually worth more than that, but it's trading at less than that. So it's trading at a discount to the perceived value. So that would be a buy opportunity, and you would choose to buy that share. So just a few caveats. This Gordon growth model is a really quick way to determine for yourself what the true value of a share is that you're thinking of investing in. The share of a PLC, a listed company. Where this is good is for mature businesses, which are growing their dividends steadily over time. It's not good for high growth rate businesses. For really high growth businesses, the model can be a bit off, particularly when you could have a situation where the hurdle rate is less than the growth rate of the dividends, the expected growth rate, and all of a sudden the equation is negative. So it doesn't work for really fast growing businesses, or indeed for businesses that don't pay dividends. A lot of companies will not be dividend payers. But for those mature businesses that pay dividends year in, year out, like Vodafone, like BP, like Shell, this is one quick method that can take you literally minutes to work out for yourself what you think the value of that business should be, and then you compare it to the listed share price. Now, obviously, with COVID-19 and everything else that's going on, we're seeing a few things that we haven't seen before, like some of these companies that have slashed their dividends for the first time in decades. So right now, it's, you just have to factor that in your valuations. But for normal times, well, when we get back to normal and some of these companies resume their dividend paying strategies, this is one way of how you can value a business. Now, as I said, this is just the first of a series of vlogs on valuing companies. In future vlogs, we will look at alternative ways to value both PLCs and also smaller non-listed companies, including SMEs.